Thank you, Charlie, and thank you for the Manhattan Institute for sponsoring this research. So this is joint work with Krista Bauman and my colleague at Texas A&M, and Sophia Hu, who's my PhD student. So we're going to take sort of a different tack from a typical regulatory study by looking at differential bank behaviors around some size thresholds that were imposed by regulation. And in particular, as you'll see in a moment, we're going to be focusing on banks that were not directly subject to the regulation, but those that were below these thresholds. So with that set up, let me just go ahead and jump in and give a very brief background on the Dodd-Frank Act. So I think probably everyone here knows that it was a very large and complex piece of legislation, and I think that's an understatement because it created over 14,000 pages of regulations. And so our focus in particular is on two size thresholds that it created where there are new regulations or new regulatory requirements that increase as a bank crosses each of these size thresholds. So there's a size threshold at 10 billion, this is total bank assets, and there's a size threshold at 50 billion. And so if we just, for example, look briefly at the $10 billion threshold, the CFPB gets to impose some requirements on banks that are above 10 billion and not those below 10 billion. Banks above 10 billion have to have risk committees. They do stress tests internally and annually, and they face the Durbin Amendment. And I won't go into the details of all of those, but suffice it to say that a good prior is that these would impose cost on banks if we're thinking about ones above 10 billion versus ones below 10 billion. This next slide is it's not really meant to be read, it's more meant to be a cute indication of the magnitude of the additional requirements that banks over $50 billion must meet as opposed to those just below $50 billion. And so some of those are similar with the requirements above 10 billion, but there are many, many more that kick in over 50 billion. So I want to just walk through three sets of hypotheses and overview their results before I dive into the details of how we study things. So the first question, this is a standard question that one asks in regulatory research, is do we see net regulatory costs change as a bank crosses this threshold, this Dodd-Frank size threshold? And so we know that Dodd-Frank imposed regulations on the banking system at large, and what we want to be able to do is focus on the differential cost, if there were any, above the size thresholds. So before I move on, I want to understand, or I want to emphasize why I underline the word net, is that it's quite possible, if we think about the theory of regulation, it's quite possible that the regulated entities benefit from regulation in some way. There's a regulatory capture theory, and so regulators and the regulated firms sort of bargain, and they may get some benefits. And so what we'll be able to do in the test that I'm going to show you in just a moment is we'll be able to measure the net effect. And so if the net benefits, if they're net benefits, we should see some positive effects. If they're net costs, we should see negative effects. So the hypothesis or question really is, do they change? And so our evidence tells us yes, that the cost increase as banks cross the size thresholds. And so across both the $10 billion set and the $50 billion set. And so given this then, and this sort of gets back to when I was setting up on the title slide about what this research is about, is that if we think about a bank below the size threshold, and they see these banks above the size thresholds incur these huge costs, then it may well change their behavior because they said, well, maybe we're now reluctant to cross the size threshold and incur those costs ourselves. So we next asked, do the below threshold banks, do they slow growth to avoid crossing the threshold? And the short answer is yes, they grow assets, that's total assets, they grow loans, and they grow risk-weighted assets more slowly. This, of course, would be consistent with a regulatory avoidance action that's perfectly legal in the sense that if they perceive great net cost on the other sides of the threshold, they just slow down growth to try to stay below the threshold. And eventually, perhaps they go above the threshold, but at least they're delaying the incurring the cost associated with crossing the threshold. if growing above the threshold is costly in terms of, if I'm regulator is looking at my assets and imposing some additional cost on me based on the assets, then one thing I might do is make sure that if I do grow, I grow in a way that generates maximum benefits for me. So our next hypothesis then is that do the below threshold banks, when they grow, do they grow through higher rate loans? Because that's about the most profitable thing we can think of on a bank's balance sheet. So do they do that post Dodd-Frank? And again, the short answer is yes, they charge significantly higher loan spreads post Dodd-Frank. Okay, so these are our three main findings, that there do appear to be costs as banks cross the thresholds. Banks appear to try to avoid those costs by slowing growth, and when they do grow, they charge really high loan rates, and we'll see what that is quantitatively in just a moment. Okay, so in setting this up, we want to understand how we're trying to get at this from a scientific research standpoint. And Charlie, when he introduced the conference, we were talking about identification strategies and establishing causality, and we've heard some of the other authors talk about that. And so it's probably tempting in a study like this to say we're going to have treated banks. Looks like the little arrows got off there or something like that. But we're going to define the treated banks as being those above 10 billion. And I'm just focusing on this one threshold in this particular example, and untreated banks being below that threshold. And now, what's wrong with this in our particular framework, although it's a very common approach in research, what's wrong with this in our particular framework is that our hypothesis is exactly about what one would view as the untreated banks. I mean, we're hypothesizing that the untreated banks, because they're below the threshold, that they are in fact changing their behavior to avoid crossing the threshold. So it's tempting to do that, and I'm going to argue that it's better to think about having three sets of banks. We have a directly treated set, and we're going to define this as like sort of near above 10 billion. So that would be 10 to 13 billion is the way we define that. We have some trade-offs where we're trying to accomplish a reasonable sample size, but still stay close enough to the threshold to have a meaningful analysis. And then we want an indirectly treated set that is going to be between 10 and 7 billion for the $10 billion threshold. And again, so what we're doing is we're trying to say, these are banks that plausibly could be expected to change their behavior if they perceive it to be very costly to go above $10 billion. And so they're close enough to the threshold, and we therefore call them indirectly treated, potentially. So the regulation was not about them. The threshold requirements are not about them. But if they look to the future and say that they could incur those costs in the future, then we could expect an indirect effect. And so then we want to get away from the threshold a bit and define an untreated set, and we define that to be $4 to $7 billion. And so those are, we're trying to get away from the community banks and keep banks relatively similar in the types of businesses that they do, while still getting a set that's far enough away from the threshold such that they're probably not worried about it. And so then our test will compare the indirectly treated set to the untreated set. And in a scientific standpoint, we're trying to get a causal effect here and look at how these differ as if they were randomly assigned to those two groups. Okay. So when we define the groups we're studying, the treated set is going to be 10 to 13 billion, and then at the 50 billion threshold, it's just essentially that multiplied times 5, so it's proportional. So 50 to 65 billion. The indirectly treated set is 7 to 10, and then 35 to 50. And then the untreated ones are, I'm not sure where those went. I guess they're off the slide, are the corresponding ones below that. Okay, so first, let's step through the details of the regulatory cost hypothesis. And essentially what we're going to do is what's called a regulatory event study. And we typically think of equity holders in banks as being concerned about the future cash flows, the future revenues, future cost of banks, so that if we look at when important regulatory events are announced, we can look at stock price reactions and try to infer, at least from the bank shareholder standpoint, whether they viewed the regulation would be net beneficial or net costly. So we searched for potentially informative events in the passage of Dodd-Frank. We found approximately 5 zillion of those, and needed to get a better handle on what to do there. So it turns out the Law Librarian Society of Washington, D.C. is a helpful organization. that classifies a lot of, or collects a lot of data about the passage of regulatory events, or acts, and they rely on a list, or they have a list, and we just rely on that entirely. So we form separate portfolios. I won't go into the details of why portfolios are necessary, but you could think of that we take our banks that are in these three sets and form like a portfolio as if it were a stock portfolio, and then ask how the stock portfolio reacted when news came out. We're going to do what's called a hedge portfolio to be able to test differences between groups. And we're going to use what's called a market model, which is basically we're trying to take out broad market movements. So if the entire stock market has a really bad down day, we don't want to attribute that to news about Dodd-Frank. And so we're netting that out with purpose of a market model. And the return, the first one I'm going to show you is just around a 2-day window. So I'll jump to this result. When Dodd-Frank was signed into law, the cumulative abnormal return, that's what CAR stands for the above threshold banks, was minus about 5%. Just over a 2-day window, they reacted 5% more negatively than the broad stock market did. For the below threshold banks, we see a minus 1%, and there's no asterisks on that, which to an academic means it's not statistically different from zero. So we can infer from this that the below threshold banks have essentially no reaction to the signing of this, whereas the above threshold banks get socked by negative 5%. If we take all of those days in that law librarian list and measure abnormal returns on all of those, the cumulative abnormal return for the above threshold banks is more than negative 10%. And so I say over the entire period, these are all the days on which important events about Dodd-Frank were being discussed. And for the below threshold banks, again, it's statistically not different from zero. All right. So the big takeaway here is that at least equity holders in banks, when they were receiving the news about Dodd-Frank, viewed that it would be very costly for above threshold banks. So then, of course, that motivates our hypotheses about would the banks grow at a slower rate. So coming to the growth hypotheses, we thought about this a lot and actually approached it a couple of different ways before deciding what I thought was the right way and the best way. And so we're going to try to approximate what a randomized experiment, kind of thinking about like drug research. We want to take a set of mice that are all identical and we want to randomly treat some and not others. And ideally, the only difference between the ones that receive the drugs and the ones that receive a placebo would be the fact that they're otherwise identical except for the drug difference. So with this randomized experiment, what we're going to do is we're going to choose pairs of banks that have similar assets in 2000, and they actually grow at a similar rate between 2000 and 2006. Now, 2006 seems like a strange date to choose, but we're trying to get before the financial crisis when the whole world went haywire, and trying to essentially say that they're starting out life in 2000 as being a similar sized bank. They grow at a similar rate. They have a similar capital ratio at the end of 2006, and they're either above or below their historical average capital ratio because banks tend to pay attention to that. And so these are things that we would expect would affect their growth because, of course, capital ratios are a function of assets in part. So these matched pairs, ideally, they were similar in their growth patterns pre-Dodd-Frank, and yet one of them sort of randomly wound up above the threshold and one randomly wound up below the threshold. So this is a diagrammatic representation. I kind of wish the real world worked so perfectly, so this is like a cartoon version of what we're trying to accomplish. And you can see so that back in around 2000 they're similar, they kind of grow the same roughly growth rates, and then that threshold is right at the time that we want to study when Dodd-Frank kicked in. One winds up right above and one winds up right below. And so these would be the two mice that I want to be identical, and I want to say one is close to this threshold and one is not. We employ what's called a bias-corrected matching estimator. Given the audience here, I'm not going to go into the details of what we do there, but essentially, it takes matched pairs, and if there are any differences between them, it attempts to correct for any bias induced by that. And so we're going to estimate what's called an indirectly treated effect. I have that like in single quotes because we would normally call this a treatment effect. But again, the very fact that we're saying these banks were not treated and they're trying to avoid being treated, so we'll call that an indirect treatment effect. And we compare those to the untreated banks, which are the counterfactual. So that would be, all right, how would the bank behave if it were not subject to the size threshold requirements? And then we're going to estimate a semi-treatment effect by comparing treated banks to the indirectly treated. It seems that treated banks are probably too far away from the untreated set to have a meaningful comparison, so we'll just compare those. And when I say it's a semi-treatment effect, it's not a pure treatment effect because both groups are potentially reacting to the Dodd-Frank regulation. Okay, so what do we find? Effects on the growth rate for the indirectly treated banks across these three categories, we find very large economically and highly statistically significant treatment effects or indirect treatment effects. And so again, these would be compared to what we want to think of as counterfactual, that in the absence of Dodd-Frank, their growth rates would have been higher by those numbers, positive of those numbers. And so for the treated banks, we have really large numbers here, and I just want to give a caveat that we have pretty small sample sizes on this, so if anybody wants to take numbers away from this, I would attach a big caveat to that second set, but I'm very comfortable with the top set. Those are based on larger samples and seem in line with what we would expect given that negative 10% stock price reaction associated with crossing the thresholds. It's reasonable that banks would want to avoid that. Okay. So then the next hypothesis, if you recall, is that if the banks are going to grow, given that growth is so costly, then do they do so through the highest yield assets they can, and that would be through high rate loans. So I think Matthew mentioned earlier using the DealScan database. This is a database of syndicated loans. So we collect all loans from there, identify the lead arranger, and then intersect that with a list of U.S. banks. We estimate kitchen sink loan pricing model. So kitchen sink is a term that researchers use when they're basically trying to control for everything they can possibly think of and then see if there's any other effect remaining. So throwing in everything, including the kitchen sink. I'll talk about what that is in a moment. And then the approach will be a difference in difference regression that we've already had described. We'll have various dummy variables. I'm not going to show you the regression table, but all those are in there that tell us what these treatment effects or indirect treatment effects would be. So this is what we have. On the loan characteristics, we have maturity, size, an indicator variable for yes, no, does it have performance pricing, and a yes, no variable for is it a secured loan or not. For the borrower, we have their assets, what we call a market-to-book asset ratio, which can get at a variety of things like their growth opportunities or their intangible assets or things like that. Their leverage, profitability, asset volatility, cash flow volatility, distance to default, a financial constraint index, and the Z-score. Normally, I would not read everything on a slide like that, but the point that I want to make is that we are controlling for just about everything you can think of regarding the borrower risk, and that at the macro level, we're comparing or controlling for a credit spread and term spread, and then at the bank, we control for their asset size and whether they had a previous relationship with the borrower, yes, no. So here's what we find. The indirectly treated banks, the post-Dodd-Frank loan spread is 26% greater than before. Again, that's like a difference in difference effect, so that's additional on top of what the untreated banks have. So the mean pre-Dodd-Frank spread is 288 basis points, so we're talking about 75 basis points of additional cost. If you know anything about loan spreads, that's a very sizable effect economically. The treated banks in our sample show no significant difference in the loan spread. So given that they're already above the threshold, they've already sucked up the cost. They don't face the same incentives and trade-offs that the below threshold banks do, so we don't see a loan pricing effect for them. So the below threshold banks significantly increased, and I want to emphasize they increased the part of the loan spread that is unexplained by any other variable. And so it's not like they were going to riskier borrowers or they're making different types of loans or anything like that. We're controlling for all of that. So they've increased the part of the loan spread that's unexplained by other variables. And that, of course, is consistent with the hypothesis. And then there's two possible interpretations that I think are interesting, and we have no way as of yet to disentangle these. I think with time we'll be able to. But the banks could be making riskier loans, and the risk is unobservable with the way that we're controlling for it. So there's something about risky borrowers they're seeking out, and even if we think about their assets and their leverage and their profitability and their cash flow volatility and things like that, there's some additional risk. But it's also possible that if banks are dominant players in these markets and there's limited competition, that they're able to just overcharge some borrowers who don't have better alternatives. You know, if a borrower is in a market with primarily below-threshold banks and all the below-threshold banks face the same incentive to jack up their spread, they could just be overcharging the borrowers. Okay, so takeaways. The evidence suggests that DoddFrank created what I'll call a kink in which the net regulatory cost increased significantly above size thresholds. And this is, I don't think the importance of this can be overstated. In other work that I'm doing, we show theoretically and empirically that this also just sort of has a more generic implication for how much risk an institution would have if there's a regulatory size threshold. It doesn't just have to be banks, it could be anything else as well. And so as a consequence, below threshold banks slow growth significantly post Dodd-Frank. They charge higher loan spreads. And then notably, nothing that I found in Dodd-Frank suggests these effects were intended by the regulation. So I'll go out on a limb and say maybe these are unintended effects of Dodd-Frank that perhaps policymakers want to think about when they have these size-based regulations. That's all I have. Thank you.
Great. Thank you all for being here, and thank you for putting our papers on the program. So I'm delighted to present to you this paper, How the Dodd-Frank Act Affected Bank Acquisition Behavior, a paper that I co-authored with Shane Johnson and also with Shraddha Bindal, a PhD student at our school. So the paper that Shane just presented, a clear conclusion from that paper is that the Dodd-Frank Act seemed to have increased the net cost for banks right above the Dodd-Frank size thresholds. Now, one implication of this may be that banks right below the size threshold, that they have actually incentives to grow less fast. And what this may mean in terms of acquisition behavior is that maybe these banks are now less likely to do acquisitions. And there's actually anecdotal evidence that supports this. However, interestingly, there's also anecdotal evidence that actually suggests that maybe banks right below the size thresholds, they simply want to grow, and maybe now they're becoming more acquisitive, and maybe they want to jump over the size thresholds in a bigger way. Thank you. And here I have a few quotes to support this. So the first one is by the CEO of New York Community Bancorp. And he said, "We'd prefer to jump through the 50 billion mark with a large deal. Our goal is to grow to as much as 80 billion in assets in one fell swoop. Otherwise," he says, "the avalanche of new regulatory burdens that come with the milestone won't be worth the benefits." Another quote by an analyst from Keefe, Bruyette and Woods. "Because climbing to a higher regulatory tier can drive up compliance costs, firms that do it can feel pressure to grow even more. A bank crossing the $10 billion mark, for example, will probably need to reach at least $12 billion quickly to get an appropriate return." So what's interesting for us is that, yes, we could find that banks become more acquisitive, or maybe they become less acquisitive. And so that's exactly what we study in this paper. So we examine the effects on bank acquisition behavior. And what we find is, here I just give you a quick overview of our results. And then after I'm done presenting this quick overview, I'll walk you through all of these analyses more slowly. Okay, so interestingly, what we find is that banks below the Dodd-Frank size thresholds don't seem to behave in a similar fashion. When we look at the banks right below the $50 billion cutoff, we find that those actually become less acquisitive after Dodd-Frank, whereas the ones right below the $10 billion cutoff seem to have become more acquisitive after Dodd-Frank. Now, we look at a few additional things, like we look at the acquisition premiums, and I'll explain to you in a little bit why we look at this. We find no effect on the acquisition premiums paid by these banks. There's also no effect on the acquisition cumulative abnormal returns around the announcement. We also find no evidence that these banks are actually more or less likely to cross a size threshold. But for the banks right below the $10 billion cutoff, we do find that if they do cross the size threshold, they do it in a more aggressive way. And also they continue to grow faster for at least 3 more years after the acquisition. Okay, so let me now tell you a little bit more about our sample, the data, and walk you indeed through everything more slowly. So in our analyses, we focus on the period from 2000 till 2015, and we focus on commercial banks and bank holding companies. Now, for the commercial banks, the financial statement data that we use comes from the call reports, if it's available, and if it's not available, we use data from Compustat. For bank holding companies, we use data from the FRY 9Cs. If that's not available, we look at the individual banks that make up the bank holding company and use their call report data. If that's not available, we use data from Compustat. Now, the acquisition data that we use comes from Thomson 1, and there we do impose the requirement that the acquirer is either a commercial bank or a bank holding company. We want to make sure that we capture true acquisitions. So any within bank holding company merger we throw out. And also we want to make sure that the acquirer obtains at least a sizable stake in the target. So we require that at least 50% of the shares are being acquired. Now, Shane did a great job explaining the different size groups that we study. So in the first paper and in this paper, we use exactly the same groups. So we have treated banks, indirectly treated banks, and untreated banks. The treated banks are the ones right above the DoddFrank size thresholds. The indirectly treated banks are the ones just below the size thresholds, and the untreated banks are the ones far below the size thresholds. Now, okay. Just like several authors before me have already noticed, some of the boxes and lines, I guess, appear to have changed their positions, because on my screen it looked perfectly fine. And this is the first time that I think this actually happens with a PDF file, because I always create PDF files to make sure that this doesn't happen. Okay, so... But you can still see more or less what I wanted to emphasize here. Let me first make a general point. So you'll see here 2 panels. A panel A, in which we define the post-Dodd-Frank time period to be 2010 through 2015. And a panel B, right next to it, in which we define the post-Dodd-Frank period to be 2011 through 2015. Now, the reason to use these 2 different definitions is that since we're studying acquisitions in this paper, and it takes time to actually, do an acquisition, it's not clear whether the first definition is better than the second one. And so in all of the analyses in the paper, we presented both ways. Here, during my presentation, in many cases, I'll just present the results using one definition, the second one, but in the paper we show it both ways. Okay, I also want to emphasize, just like several people before me have done, yes, we include quite a few different control variables. So we include a post-Dodd-Frank dummy, size threshold variables, bank level controls, bank and year fixed effects, because indeed we do want to find out what is the effect of indeed Dodd-Frank on the acquisitiveness of the banks, and we don't want this to be inadvertently driven by something else that we should have controlled for but haven't controlled for in our regressions. Okay, so what do we find? So this is the same slide as before, but now I only show you the second panel. What we find here is when we look at the effect of Dodd-Frank on the likelihood of doing an acquisition, we find that for the banks, the indirectly treated banks, so the top box, the banks just below the $10 billion threshold, the coefficient is positive and significant, again indicated by the asterisks. So positive and significant, meaning that banks just below the $10 billion size threshold, they seem to be more likely to do an acquisition after Dodd-Frank. When you look at the next box, banks right below the $50 billion size threshold, they are less likely to acquire after Dodd-Frank. Now, when we look instead at the number of acquisitions that these banks do, we find similar results for the banks right below the $10 billion cutoff. So they seem to be doing more acquisitions. So all in all, the results of these two analyses seem to suggest that Dodd-Frank has indeed changed the acquisitiveness of banks. Banks right below the threshold seem to have become more acquisitive, and the ones right below, the ones right below the $10 billion threshold seem to have become more acquisitive, and the ones right below the $50 billion threshold less acquisitive. So keep that in mind as we go forward. So now the next thing we do is we look at acquisition premiums, because given that we find that banks right below the $10 billion threshold, they have become more acquisitive. So there's now potentially more competition for targets. So maybe they end up paying higher premiums. And maybe the ones right below the $50 billion threshold, since they have become less acquisitive, maybe they now pay lower premiums. But when we actually look at this in a regression context, we actually find no effect for the banks right below the size thresholds. And maybe surprisingly, we do find an effect for banks right above the $50 billion threshold. Those actually seem to be paying higher premiums after Dodd-Frank. And so what may be going on here is that for banks right above the $50 billion threshold, since there are all these additional costs associated with being above the size threshold, and Shane mentioned this very long list of additional requirements imposed on these banks, maybe the increased economies of scale associated with acquisitions makes that these banks don't mind paying a higher premium for targets. We also look at the announcement effects around these acquisitions. And so here we focus on cumulative abnormal returns. And Shane already indicated that essentially when you look at abnormal returns, what you try to do is you try to take out the effect of what the market does. We focus here on 3-day cumulative abnormal returns, so from 1 day before the acquisition announcement all the way up to 1 day after the announcement. And here, what we expected to find is that since the banks right below the $10 billion cutoff are becoming more acquisitive, that maybe actually the announcement returns for these are worse. Also, on the previous slide, I showed you that banks above the $50 billion cutoff are paying higher premiums after Dodd-Frank. So maybe actually investors don't like this. At least if these are worse acquisitions, then you would expect to find lower announcement returns. For banks right below the $50 billion cutoff, since these are now less likely to make acquisitions, maybe actually the acquisitions that they do are better acquisitions, and maybe the announcement returns are higher. But here, when you look at this, nothing is significant, so there doesn't seem to be any effect on the announcement returns. Now, and we've looked at this here. I'm only showing you one set of regressions, but we've looked at this using different kinds of models, and they all seem to point at the same thing: no effect. We also look at the effect of Dodd-Frank on crossing a size threshold. Because given the fact that the banks right below the $10 billion cutoff have become more acquisitive, maybe they're more likely now to cross the $10 billion threshold. And the banks right below the $50 billion cutoff, since they are less acquisitive after Dodd-Frank, maybe they're less likely to cross the size threshold. But here, when you look at the results, and we limit here our sample to banks that are right below the size threshold, we cannot include the entire sample because the ones above the size threshold are already above it, and the ones that are really far below, you wouldn't expect them to jump above the size threshold. So we limit our attention here to the ones just below the size threshold, and we examine, are they more likely to cross the size threshold? And again, here we find no effect. Let's now ask a different question. Well, okay, if we just focus on banks that actually do they actually cross in a way that's more aggressive? Because think back to one of the quotes that I gave early on, there's some anecdotal evidence that suggests that banks actually want to grow. They want to grow, and if they do cross a size threshold, maybe they want to do it in a bigger way, so more aggressively, simply because they want to make sure that they can cover the additional costs associated with Dodd-Frank. So here we focus only on banks that indeed do cross a size threshold, either before Dodd-Frank or after Dodd-Frank. And here, unfortunately, we can only focus on the $10 billion threshold because there's too few banks that actually cross the $50 billion size threshold to yield meaningful results. So we look at this in a few different ways. So we have, in the first column, you see a continuous variable. And the continuous variable really it measures, are you 1% above the size threshold, 3%, 5%, 7%, whatever the actual number is. And then in the next two columns, we have two dummy variables that indicate whether a bank jumps above the size threshold by at least 10% or by at least 20%. And what you see here is that after Dodd-Frank, banks do seem to cross over the size threshold in a more aggressive way. Especially, the coefficients are always positive. They're close to being significant when we use the first definition of Dodd-Frank, being 2010 through 2015. But when you look at the second panel, where we use the other definition, so post-Dodd-Frank is the period from 2011 onward, we find strong significance and focus on the 0.423 with the two asterisks. It suggests that banks indeed do cross the size threshold in a more aggressive way, and they're more likely to jump over it by at least 10% after Dodd-Frank. Maybe surprisingly, they're not more likely to jump over it by at least 20%. This may be surprising, and here I have another quote by the CEO of Old National Bancorp, and it says here, it has flirted with the $10 billion threshold for several quarters. The bank is highly acquisitive, but also reluctant to forfeit an estimated gross $2 million to $3 million quarterly in lost interchange income. President and CEO Robert Jones told SNL that Old National needs to reach 12 to 12.5 billion in assets to recoup the costs and provide value to shareholders. So you would have expected that banks who cross it by at least 20%. We don't find that, but maybe they don't do it all at once, and maybe they can actually get to the size that they need to recoup the cost by simply growing faster after crossing the size threshold. So that's what we look at in our final analysis. And here we look at growth after they have completed their acquisition. So after they've crossed the size threshold, what is their growth 1 year, 2 years, 3 years after crossing the threshold? And here in this particular setup, we use again a difference in difference approach where we use a matched sample. So our matched sample, we match crossers with banks that are very similar, but that did not cross a size threshold. And then when you look at the results, we find here that the ones that actually crossed indeed grow far faster 1, 2, and 3 years after after crossing the threshold. Okay, so let me wrap up. In this paper, we examine the effects of DoddFrank on the acquisition behavior of banks. We do find different effects for banks right below the $50 billion threshold and right below the $10 billion threshold. The ones right below the $50 billion threshold become less acquisitive. The ones right below the $10 billion threshold become more acquisitive. No effects on premiums, no effects on the announcement returns, no effects on the likelihood of crossing a threshold. But if they do cross a threshold, they seem to cross it in a more aggressive way, and they continue their growth after crossing. And overall, these results suggest, and I guess the very last line got cut off, just like in one of Shane's slides. So it does indeed suggest that Dodd-Frank did change the acquisitiveness of banks, and that there indeed may be unintended consequences. It seems to have affected especially the behavior of the banks right below the size thresholds. Thank you.
Well, thank you, Charlie. Thank you to the Manhattan Institute and to Smith Breeden. I'd also like to thank just about everyone who's presenting a paper today, because back in December we had a pre-conference conference, and I think just about everyone speaking today had insights and made comments and suggestions that's made our paper much better. This is joint work with Isabelle de Séquin and Amin Tarazi, both from the University of Limoges, and Amin is here with us today. Well, our paper begins with a very basic observation, and that is that for 20 or 25 years, banks' balance sheets have, by regulation, been constrained by a minimum capital requirement or a set of minimum capital requirements. Given the liquidity events that drove the global financial crisis, the Basel III Accord introduces a second balance sheet constraint. And now banks are be faced with the minimum liquidity, balance sheet liquidity constraints. The interesting thing we thought is that nobody knows how banks are going to react when they're constrained twice. This is really a much more complicated question than it seems at first. And one of the reasons is because although capital ratios and liquidity ratios are not the same, they're made up of the same elements. And we know that balance sheets have adding up constraints. So when one of these two ratios changes at a bank, another is likely to be affected. Now that's just mechanical. Balance sheet capital constraints and liquidity constraints, banks adjust these based on their risk-taking appetites, so how one of these ratios or how binding one of these ratios is for a bank could be related to how binding the other ratio is for a bank, based not just on mechanical accounting ratios, but also on the behaviors of banks. And in this paper, we're trying to get at the behaviors of banks in a world where they're constrained twice. To make it simple, I mean, we're going to use these words complements and substitutes. When one constraint tightens, does a bank take actions to move further away from the constraint, the other constraint, or do they throw caution to the wind and actually take actions so that the second constraint is also more binding? Well, if a bank acts in a way that both restraints get more binding at the same time, we say we're going to use the language that capital and liquidity are complements in practice. If we see a capital ratio getting more binding and liquidity, the bank becoming more liquid, we're going to say in that case that capital and liquidity are in practice are substitutes for each other. Now, to get a little more specific here, what we're going to do is we're going to go back to the period of time before the Basel III, liquidity requirements were implemented either in Europe or in the United States. Now, it would be nice to be able to look at a world with a long period of a series of data, and see how banks that face capital constraints or close to a binding constraint, or banks that are close to a liquidity constraint, react in both directions. We don't have enough data yet to do that, so we're going to look before 2012. When banks are operating with just a single constraint on their balance sheets. We're going to take a look at when these banks become close to their capital constraints, when they're facing capital stress. How did they change their balance sheet liquidity? Now, this is a purely behavioral reaction, right? During our time period, banks are not faced with regulatory constraints requiring them to hold a certain amount of regulatory liquidity. So there's two potential outcomes here, and they have implications for whether this Basel III liquidity requirements are going to change or not change bank behavior. If a bank is capital stressed, takes actions to reduce their balance sheet liquidity, then the Basel III liquidity constraints are likely to affect bank behavior. Banks with capital stress will be limited to how much they can reduce their liquidity, because there'll be a floor under how much liquidity they can do without. But on the other hand, if we find out that banks that are under capital stress take actions to increase their balance sheet liquidity, then the Basel III liquidity constraints are unlikely to affect bank behavior, right? And this is particularly important because a capital stressed bank, that's the state of nature that regulators have traditionally been the most concerned about. All right, so that's the implications here. We're trying to see whether or not banks move capital and liquidity as substitutes or as complements. Very briefly, some literature. This is not a large set of literature. I start with one theory paper by Ansgar Walther, a theory paper that shows that failure risk, it's theoretically possible, he shows in the theory model, that failure risk can be reduced by a Basel III approach that jointly constrains both capital and liquidity. So theoretically, this can be done. All right. Let's take a look at four papers here who have tried to have investigated the relationships between capital and liquidity on banks' balance sheets. In Birowitz and Rauch, they took a look at bank failure models, an empirical paper. They find that in some cases, credit risk and liquidity risk amplify each other and make failure either more or less likely. In some cases, they offset each other. So it's not clear the relationship between the drivers of insolvency, whether it's credit risk or liquidity risk. Sometimes they amplify, sometimes they offset. A paper by my co-authors, they also find somewhat noisy results, not noisy results, but contradictory results. When they look at data on large banks from multiple countries, they find that banks respond to reduced liquidity by reducing their capital ratios. So that's liquidity and capital are complements. But then when they look at data on small U.S. banks, they find exactly the opposite result. So not a clear answer for all banks in all situations. Now there's two papers that simulate how Basel III should affect banks' actions if they have to increase their liquidity to get above the Basel III liquidity minimum. One paper finds out that, or determines that banks will achieve the liquidity minimums by increasing their stable deposit funding, okay, the right-hand side of the balance sheet. The other paper, a very similar approach, finds out that, comes to a different conclusion, that banks will meet the minimum liquidity requirements by increasing their liquid assets, by making changes on the other side of the balance sheet. So we have a lot of noise in the literature here, right? So we may be adding to the noise, or we may be helping to find a truth here. But this is a literature that, what do they say? It's we don't have what do they say in global warming? What's global warming literature? It's a conventional. There's a subterm. It's a conventional result. Accepted science. That's it. There's no accepted science here yet. So what do? We use a two-stage approach. The first thing we do is we estimate a target capital ratio for each bank in each year of our data. We use standard approaches here. The idea here, now this second bullet with the red ink, you'll either accept our methodology or you won't accept our methodology based on this red bullet. By definition, this is by our definition, if a bank's operating below its own target capital ratio, that's what a target does. We're estimating using standard techniques how much, not how much capital a bank holds, but how much they want to hold. If a bank's operating below its own target capital ratio, it will not willingly choose to further reduce its capital ratio. All the papers that have estimated a capital adjustment at banks find that when banks are below their capital ratio, their target capital ratios, they adjust upwards at a fairly rapid rate. So we define this variable called shock as a dummy variable. It equals 1 if a bank that's below their target capital experiences a reduction in their capital ratio, a further reduction in their capital ratio. In other words, moving in the direction opposite of where they would like to be. And we're going to claim that, defined this way, that shock, our shock dummy, is an exogenous measure of a shock to bank capital. Now we're going to use two different capital ratios to estimate all of our models. One is a simple equity to asset ratio. The second, and the one which we find all of our results for, is the total Tier 1 plus Tier 2 capital ratio to risk-weighted assets. The important difference between these two, of course, is that the risk-weighted capital ratio the risk-weighted capital ratio signals, hones in on credit risk, right? So that's the important, and the fact that we find most of our strong results for the Tier 1, Tier 2 capital, risk-weighted capital ratio is an important finding, we think. Well, here's the timing in our result. We look at we start T minus 2. At T minus 2, we observe banks that are operating below their internal capital targets. Then if the bank's equity capital ratio declines even further, we say that's a shock between T minus 2 and T minus 1. And then between T minus 1 and T, we test the question, how does a bank adjust its balance sheet liquidity to that shock? Here's the second stage, our test regression, and we're measuring liquidity by a change in the net stable funding ratio, the NSFR, and the NSFR is exactly what it sounds like. Right? It's a net stable funding ratio. It's the ratio of stable funding on the right-hand side of the balance sheet divided by long-term or illiquid assets. And the Basel III rules say banks should have an NSFR above 100%. More than enough stable funding for their illiquid assets. We're regressing this on the shock variable. We're also regressing this on a dummy variable called below, and the below equals 1 if a bank is below its capital target at T minus 2 at the beginning. Now, it's important to control for this because we'd like to know if banks that are below their capital target increase their liquidity even if they're not shocked. Then we have the shock for the second event. Okay, first stage results. The capital targets, the adjustment speeds are slower than in the literature, but most of the literature looks at publicly traded firms. 3/4 of our banks are not publicly traded, so their adjustment speeds are necessarily slower. The shocks, they're non-trivial. These capital shocks, 98 basis points for the risk-weighted asset ratio, that's a substantial shock to a capital ratio. So here's what they look like over time. You might think that these shocks would happen more often during the financial crisis. They don't. We have a lot of shocks over time, so that's nice to see. The mean size of the shock, a little bit higher after the financial crisis, but it's still a meaningful size throughout our sample period. And here's how our net stable funding ratios change over time. You see that banks become less and less liquid as we move towards the financial crisis, and then they add to the liquidity after the financial crisis. So this picture here tells you how important it is to have time-fixed effects in your regressions. So here's our main results here. On the left hand, you see on the right-hand side, our model is being estimated for the simple equity to asset ratio, no results. On the left-hand side, our model is being estimated for the risk-weighted capital ratio, risk-weighted assets ratio. And you can see that our results are really only for banks that are small, below $1 billion, the traditional definition of a community bank. So how do we interpret these numbers? For below, the banks that are below their capital ratios and don't receive a shock increase their liquidity by 80 basis points. If they're then shocked, they increase their liquidity by another 50 basis points, adding up to about 1.3 basis points. That would be a movement from an NSFR of 100 to an NSFR of 101.3. So that's a non-trivial response or non-trivial increase. We have a bunch of robustness tests. These results don't go away. The nature of these results don't disappear. We have a couple of subsample regressions that are important to do. We'd like to know whether this result is only for banks below $1 billion. Does it get more intense as banks get smaller and smaller and smaller? The second subsample we're looking at is that we all know that there's theory and there's empirical research that finds that banks with high levels of absolute capital, high franchise value, act in a less risky way. So we're going to test that as well. So on the left-hand side, we're looking at banks below $1 billion, but banks that are very small compared to only small. And we see as we get to the very small banks, these results get larger, both for below and for the shock. So the smaller the bank, the more likely they are to treat their liquidity as a substitute for capital. On the right-hand side, we get the classic result that when you have a lot of franchise value, high capital ratios, you're acting in this case to add liquidity. If you're shocked to your capital, you add liquidity. So for banks that have lower absolute levels of capital ratios, we find no results at all. Finally, behavioral channels. I will skip through, because I know I'm pressed for time here a little bit. I will skip through here and just go straight to these channels. What we do here is we essentially take our second stage model and we put various balance sheet and income statement ratios on the left-hand side. What we want to do is find out not just whether banks, in response to capital stress, increased or decreased their liquidity, we want to find out how they did it. And we can infer something if we know something about the channels. We sometimes in these models use the shock dummy variable as our exogenous shock, and sometimes we use a continuous variable. How many basis points was the shock? A continuous variable of the shock. As you can see here, a very constant pattern. In response to a capital shock, it looks like banks take actions to increase their capital ratio, to repair their capital ratio, and that this suggests we only get an ancillary increase in liquidity as a result of actions taken to repair the shock. Right? So if you get a capital shock, it says here we reduce our asset growth rates, we reduce our loans to assets, we reduce our business loans to assets, we reduce our loan commitments to assets. These all repair the capital ratios, but they also make balance sheets more liquid. Each of these movements. So now we understand a little bit more now about the connection between these two things. Banks are repairing their capital ratios, and in the process of that, their balance sheets become more liquid. Notice that we have no results for the core deposits to total deposits ratio, core deposits being the most stable of all deposits. This is a very important result, actually, because core deposits are in no way related to capital ratios. If a bank wanted to increase its liquidity just because its capital went down, one of the ways it would do it would be to increase their core deposits, make their deposits more stable. We find no evidence of that at all. So this is all happening because of the substitution of liquidity for capital is all happening because banks are trying to repair their capital ratios. And then we also find that banks cut their dividends when they're in capital shocks. And of course, if you cut your dividends, you become both more liquid and it repairs your capital ratios. So, in conclusions, we have 6 of these. Banks respond to their risk-weighted capital shocks with non-trivial increases to their balance sheet liquidity positions. Our result is limited to community banks, and its strongest responses at banks that have high franchise values. Number 2 is a more subtle result, but it's important. For banks of all sizes and all equity levels, we continually reject the notion that balance sheet liquidity declines in response to capital shocks. In other words, we find no evidence at all that banks effectively treat capital and liquidity as complements. Number three, liquidity is not a direct substitute for capital. We're finding a relationship between the two because of ancillary changes in the process of rebuilding capital ratios. Number four, and this is important too, in the state of nature that bank regulators traditionally worry about banks, and that is capital distress, banks do not reduce their balance sheet liquidity. So this is interesting. Now we know in the financial crisis, one of the drivers of insolvency was an increase in liquidity risk. Banks are hit by liquidity problems, but in terms of them being related to each other, we're not finding that balance sheet liquidity is amplifying the risk of insolvency. Regulatory capital constraints matter most for bank liquidity behavior. We find the result for the Basel risk-weighted ratios, but not for the simple equity to asset leverage ratios. And number six, what does this suggest for policy? Suggest that Basel III liquidity rules should be implemented conditional, whether this is formally or informally, whether it's guidance or not guidance. I leave that to people smarter than me in Washington. But evidence suggests that these liquidity rules could be implemented conditional on bank size or bank franchise value. In Europe, all banks, regardless of size, have to meet these NSFR minimums. But in the United States, the Federal Reserve has, and the bank regulators have excused small banks from having to meet these Basel III minimums, which in this case, regulation preceded the research. So I'm not sure if that's the best way, but this is what happened in this case. Thank you very much.
Please come on up. While everybody's thinking of some questions, I'm going to start with a question about the last paper for Bob. So actually, these results, Bob, are remarkably similar to results in the historical banking literature that I have produced for the 1890s and for the period 1920 to 1940, which I find quite interesting, because one way I would look at this is the small bank results you're getting that's how market discipline works. That is, this is the way disciplined banks respond. And so my question then is, for example, here in New York City banks, from 1929 to 1939, the ratio of loan to assets fell from 75% to 25%. And conversely, the ratio of cash to assets rose from 25% to 75%. And that was all an adjustment to losses of capital and to a targeted sort of, and so what's happening is, as the banks are getting more worried about their insolvency risk because of shocks, they're accumulating cash. The way I would look at it is, it's easier to accumulate cash than it is to raise stock when you're suffering a negative shock, a kind of adverse selection story maybe. But another thing that your results sort of points to is that maybe large banks aren't feeling disciplined the way small banks do. Maybe small banks feel like regulatory discipline is more binding on them. What do you think about that argument?
Well, first of all,
please come to the mic.
Yeah. Those are interesting results, and we're looking at small banks, and small banks in the 20s, banks are small banks. So this is very interesting. The missing element is deposit insurance, of course. Of course, that changed the game quite a bit. There's, I would, I think the difference, why we don't find this for large banks, is because large banks tend to hold things on their balance sheet that are liquid. And small banks tend not to hold things on their balance sheets that are liquid. So when they have shocks to their capital, there's fewer places for small banks to turn. Large banks can shrink by getting rid of their liquid assets. Smaller banks have more trouble doing that. That's the way I've been thinking about it. But response, now, our large banks start at $1 billion and plus $1. So I'm pretty sure that banks that are $5 billion or $10 billion or $15 billion feel like they're exposed to regulatory discipline. But going above that, that's one thing Amin and I have been trying to do, trying to take a look at the larger banks in different ways, but there's just not as much data up there. But I take your point, and I think we'll address that.
Okay. We'll start with Alan.
Thanks very much. First of all, I must compliment all three authors. I went to the pre-conference. These three papers are really greatly improved, so I really compliment all of you on that. I have three suggestions for Bob.
They started out bad.
No, he doesn't mean it that way.
This doesn't mean I'm going to be nasty. No, it doesn't mean that. So for Bob, three suggestions. One is when you refer to balance sheet liquidity, it's not balance sheet liquidity. It's overall liquidity because it includes off-balance sheet.
It's just commitments, right?
Okay. Second is I encourage you to go back a little bit for the theory, and it goes back to 2000. Diamond and Rajan have a whole set of theories, and there's other people have theories about the relationship between capital and liquidity. I encourage you to go back to that. And then the third is to go back in the empirical literature to something that Krista and I have done on liquidity and capital, and we found the results also differed by large and small banks, and we used the liquidity creation measure, which I think you could also use as a robustness check.
Yeah. 1 point. Those are good. Those are good ideas. In the paper, we do talk about that it's fundamental in the bank theory literature that liquidity and capital are both important in the bank production process. That's what the bank production process is about, and we don't cite the Diamond and Rajan paper, but we have to add that. Thanks.
I've got a lot of questions up, and I want to make sure we get questions for Krista and Shane, because we just had two from them. So please, Jill.
So just had a question about the merger adjustment paper. So as I understand the sample in the pre-DoddFrank era would include the period where there would have potentially been substantial mergers associated with bank failures. And I'm just curious if we think there could be any size effects in terms of failure. For example, in the large banks, there's not many actual failure, or I'm sorry, what I'm trying to get at is if you think that mergers are related in some way to the probability of failure rising, do we think that may influence the merger rate at different size thresholds, and could that be in some way potentially affecting some of the results?
Thanks so much for that question. We also were worried that maybe indeed these results, and I think that you're referring in particular to the crisis period, that our results may be driven by the crisis period in which indeed quite a few banks were failing. And in my work with Alan, we indeed showed that it's especially during crises, for example, that, for example, bank capital helps, and that it helps you to buy indeed these failing banks. So to address this particular issue, we also did our analyses excluding the crisis, and we find very similar results.
Just to add one more thing, one of our original research questions was going to be whether Dodd-Frank would have impacted the ability or the desire for banks to accept failed bank assets. And so we actually collected a sample of all of those transactions. Intersecting that with what we had, we didn't have any sample size to work with, essentially. So it's just another way of saying that it's probably not driven by that as well, even outside of the crisis.
A very patient fellow over here. Thanks for your patience.
Yeah, for Shane, the question is, when you looked at the changes, how much did you attribute to a market segmentation effect in terms of the clients being served? And for Krista, a similar question there, but the reasons changing for crossing the threshold.
Go ahead. So I'll start. You mean market segmentation, like when the banks are slowing the growth in assets and loans and risk-weighted assets?
Composition, like the industry backgrounds of their clients, the products that are being sold to their clients, and how that mix changes.
Yeah, that's a great suggestion, something we didn't look at, so I don't know the answer to that. We were just looking at these aggregate buckets, but that's a great suggestion. Thank you.
Yeah. Can you repeat the second question? So.
Yeah, the reason for changing, so when a bank said, hey, we're going to go buy somebody, and they went and told the stock analysts and presented their strategy deck, how did the reasons change from the before to the after period?
He means cost synergies versus revenue synergies, product lines, things like that.
Geographic dispersion, product lines.
Also, a great suggestion. It's something that we haven't looked at, but we could look at that. Yeah.
Okay. Question here.
I have a brief question for Robert. I was just looking at the regression. The R square seems to be a little bit low. Could you comment on that? Or?
They're low.
Well, that's a great question.
We're in the social sciences.
Yes, we're not trying to predict, we're trying to test hypotheses. We're doing statistical inference, so that's all our goal board told me always to say that.
Say it into the microphone.
Sorry.
Yes, over here.
Sunil Mohanty from Brooklyn College, City University of New York. I have a question for Shane. I enjoyed your paper. I'm wondering what happened to the portfolio risk of the three portfolio that you have. Did it increase or decrease after the Dodd-Frank?
So it's one of the questions, when I was talking about, did the banks, are they overcharging borrowers, or did they increase some element of unexplained risk? So one of the things on our agenda is, when we have enough years, in the post-Dodd-Frank period, is to look at measures of credit quality across the banks and see if there's a systematic change in those. So it's on the to-do list, but we don't think there's enough data yet in the time series to get a meaningful test.
One more question here, and then I have one too.
Hi, Adam Beatty from Columbia. Since two of the papers regarded thresholds for regulatory requirements, just wanted to get your broader comments on the current threshold regime, if you will, and whether the levels and type of thresholds that are being used are appropriate and how those might be changed. Thanks.
So I've been thinking about size-based regulation quite a bit since this paper, and as I mentioned, I have some other work going on, and it's, without going into a lot of the gory detail about it, what I can tell you is that any size-based regulation, so this would include like banking regulations, something like Obamacare, where they had differential requirements for firms with 50 or more employees. There's a number of environmental regulations that work that way. Small Business Administration effectively works that way if you think about a cost. So what happens is that there's a big cost jump or loss of benefits as one crosses a threshold. And so it's possible to show theoretically that this creates dramatic distortions in the risk incentives of institutions around the threshold. And so in particular, ones above a threshold would be expected to be much riskier, and ones below would be less risky. And so we test this on banks around Dodd-Frank and actually find that. And our plan is to try to expand that. So I don't have any comments about what an optimal threshold is, but one of the things that we want to push policymakers to think about is it possible to achieve some regulatory outcomes without these big jumps in cost along the way.
Yeah, and there's actually, some evidence that, or at least when you talk with the regulators, that they actually view banks that are close to a threshold already as if they are above a threshold. So whether indeed they do view it that way when they deal with the banks, I don't know. I'm not a regulator myself, but I wouldn't be surprised if that's indeed the case. From the work that we've done, it is also very clear that some of the banks, for example, right below the $10 billion threshold, they said, we want to make sure that we are ready, and so that once we hit the $10 billion mark, that we already are used to stress testing and all of the other requirements that come with being above 10 billion. So does this say anything about the right level of the threshold? No, but it is definitely something indeed for regulators to keep in mind, and maybe indeed not have the actual thresholds so explicit, but maybe more like a gradual, not a gradual phase in, but maybe if you're indeed around 7 billion, some of the regulations already kick in to some extent.
Bob, you had a comment.
Yeah, just one real quick comment. In our research, we found that the Federal Reserve, the regulator, was ahead of our research. The Federal Reserve has excused small banks in the United States from these minimum liquidity requirements. Now, in Krista's paper, what she found out is that bankers were ahead of the research. Right, because you point out that with 3 different sets of quotations, that they've announced what they're going to do, and in fact, that's what they did. Now, at the time of these, I recall that the American banker was just riddled with articles like this, with quotations like this. It might be interesting in your paper if you could do a search and find out how many articles, like a number count, a numerical count, how many bankers announced publicly, that this in fact was the case.
What was the case?
What was the case was that this size threshold was going to cause us either to stop growing or to leap above, that this unintended consequence was a real thing. And now there's research that shows that bankers say something and it turns out not to be true. But in this case, it's very, very true. They weren't gaming regulation at all, right? They weren't complaining unnecessarily about regulation. They were stating this regulation is going to affect our behavior in ways that weren't meant to be.
Well, we are 3 minutes out of time, but so I think I'm going to let you ask a 30-second question. Wait for the microphone. It's coming.
The threshold 7 and 13, as well as 35 and 65, I think. Was it statistical technique, or was it based on anecdotal evidence, which you just mentioned? Thank you very much.
Yes.
That was so that was a choice just to get a reasonable sample size. So the 7 and the 35 are ones where we looked at the size distribution across banks and said, where can we draw this that trades off reasonableness with a sample size that's reasonable. So nothing told us that per se, yeah.